friends, and welcome to the CUInsight Network. My name is Robbie Young. I am the Vice President of Strategic Growth here at CUInsight, and it's my job on this show to have conversations with thought leaders who support the credit union community. We'll identify issues affecting credit unions and discuss best practices that help us learn from one another and strengthen our credit union community. My guest on today's show is Omar Jordan, founder and CEO of Coviance. Omar, thanks so much for being here.
I'm so excited to be here. Thanks for having me.
Of course. So most of us didn't think that we were going to work in credit unions when we grew up. What did you want to be when you grew up?
That's so funny. You're so right. I never thought I'd be in the banking industry altogether. I've always had a sort of a extreme ADHD. And so I think that's the make of an entrepreneur is a number one key ingredient is extreme ADHD. My dad always wanted me to be either a lawyer or a doctor. And then when nanotechnology was big back in the 90s, he was pushing me to be into nanotechnology and be a software developer. And I just dabbled in a bit of everything. I never knew what I wanted to grow up. I still don't know what I want to do when I grow up. I always knew I'm good with people and I enjoy fixing problems. And I think that's sort of what drove me to this industry is that the people are great to work with. There's a lot of opportunities and problems to fix and turn into opportunities. And that's what brings us all here.
Yeah, I like that. Maybe that's why we get along so well is because neither of us really know what we want to be when we grow up. We just keep doing the things we like.
I know. My mom still tells me, when are you going to get a real job?
So what was the journey like to your current role as founder and CEO at Coviance?
I started my career in banking as a loan officer for a subprime lending arm that HSBC owned back in the early 2000s. So I don't know if you remember household finance and beneficial, huge subprime lending. Or we did a lot of real estate loans, a lot of home equity loans. I remember those programs specifically. And then we did a lot of personal loans. And those were designed for folks that were even rejected by their credit union. And so folks that could not get qualified for a home equity loan, but yet they had an extreme amount of credit card debt at high interest rates, we would come in and help them out as much as we can. Well, when the economy collapsed, that caused default to go up. And when that started to happen, HSBC had to shut that division down. I then got introduced to credit unions, and I learned that the technology we had at HSBC processing real estate loans was decades in advance, more than credit union have even to this day, some of them. And we discovered that they're doing a lot of things on sticky notes, Excel spreadsheets, an LOS here, and then I've got to go fax my vendor there and get a title report via email. And so there was just this cluster mess of processes that folks have to take. And then on the front of it is the borrower wondering, what the heck happened to my application that I filed 3 months ago? Where are we at in the process? And I knew that was a problem. So I started to attend credit union conferences. I got to learn about a few of them. I got to meet a couple, do a little bit of R&D, and lo and behold, we started a company. It was called Lender Close, and now we rebranded to Coviance. But the idea is to bring everything a credit union or community bank needs to process a loan. And then that was the original idea. And then from there is sort of motor forward to this automation, efficiency, giving credit unions the ability to compete with fintechs and larger banks. And it's been an exciting journey. So that's the story of how I became a founder. It's just one crazy idea leads to another, and one company leads to another. And here we go.
I like it. And as someone who has got to watch, I think, a good majority of that founder journey, I know that your Coviance has a real solid impact on the credit union community. So could you tell us a little bit more about Coviance and really where they add value for credit unions?
If you think about it, we really focus on the member experience aspect of it, but we don't focus on it so much on the front end where we create an online or point of sale application or an online application that gives them the ultimate experience. That's very important. And we have technologies out there that do that, including ours. But I think where we saw a lot of disconnect is what happens once the member clicks submit my application button. Well, in the past, it would go into the dark web. No one knows what's happening. The loan officer There's too many hands touching the loan file. There are too many processes, too many bottlenecks throughout the process to originate a real estate loan, a home equity or a HELOC or a first mortgage or second mortgage. Well, we learned that if we take that process, what we call the messy middle, and automate most of it, inject some efficiencies, and ask a lot of questions throughout the process of why do we still do this? Well, it doesn't belong. It's not a compliance issue. So let's kick that process out. Let's inject more products throughout the process that allow the credit union to move faster. And then let's put a beautiful automation technology on top of it and add layers of communication so that the borrower understands where they're at in the process. The lender can monitor where they're at in the process. That shortens the lending cycle from maybe a 30, 40-day turnaround time to less than 7 days in terms of getting a home equity loan. I think that's what borrowers today need, is that instant gratification. Credit unions are competing not against other credit unions and no more against banks. Banks are not big in consumer lendings. So the number one competitor to credit union today are fintechs that are originating consumer loans and selling them back to credit unions, fintechs that are originating home equity loans and HELOCs and then selling them back to credit unions. We've abandoned this model of credit unions originating within the community and sort of shifted to a model where we acquire loans. So I think that's what we want to create, is an environment where credit unions can be more efficient by injecting automations, given them the ultimate experience, given their members the ultimate experience, shorten the loaning cycle, and allow them to compete in this marketplace. That was a big answer to your question, Robbie. I hope that wasn't too much.
No, I think that was perfect. And certainly we have a lot of people that talk about, we are the Amazon Prime generation. We are looking for things to happen fast. And really, from what you say, like, it's no excuse that it can't happen faster with the right automations and processes and systems.
You know, what's funny on top of that, Robbie, is that members, consumers are willing to pay a premium for premium service. And I think that's a misconception that most credit union CEOs and leadership has, is that I have to offer cheaper products for my members, and that's why they come to me. No. Members are chasing user experience, and whoever provides the ultimate user experience wins at the end of the day.
Right. And there's a lot of value in buying your own time back.
100%.
So many credit unions are still relying on home equity processes built a decade or more ago. What challenges does that create today? And how is Coviance helping institutions modernize and significantly reduce those cycle times we talked about?
Yeah, that's a great question. I think so. When we engage with a credit union, the number one question we try to put out there is, what problem are you trying to solve? We've got to be crystal clear on what that exactly is. And then leadership has to make a decision that change has to start to unfold. When we dive in the discovery process with a prospect or a credit union or a bank, whatever it might be, we're learning that you're right. They are still treating a HELOC in 2025 as if it was a first mortgage from 1975. We're asking borrowers to submit 2 pay stubs, 2-year tax returns. We've got to do a full detailed appraisal. We've got to do an entire process on the title report. None of that, or most of it, is not necessarily in the guidelines. So we basically copied and pasted policies from the 70s and 80s and made them policies of this generation. And this is where fintechs are winning. They started to ask questions. Is this required by legislation? NCUA, OCC, FDIC, CFPB? Well, no. So why do we do it? And the challenge we find is, if you go into a credit union that happens today still, when we ask them, why do you do it this way? The answer is, well, we've always done it this way. We don't know any better. And so that's been our key success to it, is coming into a credit union, bringing in that consultative layer to come in and ask questions, challenge them, help them, and guide them towards what success looks like. And then from there, we collectively make a decision and we add the technology layer, the Coviance technology layer on top, and it's a win-win for everybody.
For sure. And with that borrower expectation continuing to rise with speed and digital experiences becoming really table stakes, how can credit unions compete with non-traditional lenders while staying true to their values of trust and community?
Well, I think what fintechs have done successfully is they've learned from the credit union playbook of calling their borrowers members now. So you've got fintechs out there that are lenders, HELOC lenders, and home equity lenders that are calling their borrowers members, right? They're selling this illusion that if you join us, you're a member. And what happens, they turn around, they sell that member data, and they capitalize that concept. What credit unions need to do is look across the river and see what fintechs and learn from what fintechs are doing. Fintechs, and there's one out there called Figure. Figure is one of the largest HELOC lenders out there. They charge their members, their borrowers, up to a 5% origination fee on some loans. 5%. So if you think about it, a $100,000 loan, 5%, that's about $5,000 origination fee on that loan that the member pays to originate it within 7 days or less, right? That's the promise. So why can't credit unions take that model and charge a premium for a premium level service, and then take that money that they make, and I know the credit unions are not for profit, and invest it in technology, right, to continue to compete in the marketplace? We're losing market share. We're losing membership base. We're losing share of wallet because we are still stuck in the past of we're credit unions. We've got to go do it cheap. Well, cheap comes at a very expensive cost to us. And I think we're starting to see that. Luckily, we're seeing a lot of credit unions adopt technology, adopt the mentality of we have got to charge a service for that level of service that we provide. And I think we're starting to see some of that come back to the credit union land, but there's more work to do and more opportunity for us to uncover.
Yeah, such valuable information, and certainly so important when talking about staying on the cutting edge of our service. What operational or strategic shifts should credit union leaders prioritize now to ensure their home equity programs are positioned for growth and member impact over the next few years?
Well, it starts with making a decision that home equity is a priority or a strategic priority for growth. And then from there, it starts with creating a challenge within the organization to create a process or an environment internally that's as equally important as externally. So whatever processes the back office operation has to run in order to sprint from application to close reflects on what the member experience is. So you've got to make a decision and create challenges within the organization to say, okay, how long does it take us today? 30 days to process a home equity loan. Why? Let's dissect that process. Let's bring in experts like Coviance, for example, to come walk us through what success looks like, what others have done in order for them to meet or shorten that lending cycle that we need to shorten. And then from there, we start to unpack how we do it collectively together. What we learn instead, or what we find a lot of times as we go into the credit unions, is they make a decision to make home equity priority, for example, and then they go, oh, we need a new LOS. That's our challenge. No. The LOS is not the problem. The problem is the messy middle, and we are professionals in that area. We know exactly what it takes to get a credit union from A to Z in a very, very short period of time.
Right. So once you make that decision, just free up your brain space and ask experts like you all to come in and tell what's next.
Well, that's why we exist. And I love what's happening with the credit union movement today, Robbie. You're seeing a lot of investment into fintechs. You're seeing a lot of people rally behind funds like Circle, where they're really hungry and excited about making change in the industry. That's very, very positive. Well, now trust the experts that you've invested in, that you went to a conference to talk with, to come in and do a lot of the work. Because our success as a fintech that's kind of was born within that credit union movement, our success is their success. And so if they are originating loans efficiently in a way that automates their process, makes their member happy, and it keeps the member away from going to fintechs that are outside the network, then that drives a lot of our success too. So we want to see them succeed.
So in 2026, how should credit unions think about the home equity opportunity, especially given the trillions in tappable equity and rising consumer debt levels?
That's a great point. So it's no secret, right? Interest rates are higher than they were, historically higher. And yes, they'll drop a little bit, but there's still a tremendous amount of pressure on today's consumer, today's credit union member. We're just about to exit a holiday season where credit cards are being utilized to sort of make things happen within a family dynamic. And so that credit card 3, 4 years ago or longer used to have 10 to 15% interest rate. Well, now those are a 22% interest rate. So a $10,000 balance on a credit card went from $300 a month to now almost $600 a month. That's a mortgage payment for some people. And so that causes friction within a family dynamic. It causes friction on the cash flow of a family. And so they're relying on the equity in their home. And there's about $11 trillion in equity. Every borrower, the average homeowner, has about $217,000 worth of home equity, lendable equity in their home. And so for us to come in and help our members to consolidate majority of that debt, pay it off, allow them to put them on a term type loan or a HELOC to reduce that interest rate and give them that breathing room in their cash flow or balance sheet every month, that's going to be crucial. Not to mention what's happening with student loans. And then there's a lot of talk about what's going to happen with healthcare here coming up. So consumers, Americans, homeowners are going to start to feel an impossible amount of pressure here coming up. And so credit unions have to stand ready in 2026 to, one, help their members to maximize the potential and share of wallet. We talk about we want every member to have multiple products within a credit union: checking account, savings account, car loan, home equity loan, mortgage. This is the opportunity for us to maximize on that potential. And I think getting in front of it now and start putting processes now in place and making a decision to bring in experts to come in and help you to tell the better story to your member as to why to do business with you versus a fintech is very, very important. And the work has to start now.
Yeah, it's so important and so true about being able to tell the right story to your member that, they can continue to trust in their credit union.
Yeah.
So to wrap up the show, we like to have some fun with some rapid fire questions. Now, the questions are rapid, but your answers certainly don't have to be. Do you think you're ready?
I think so too. I tend to talk a lot, so hopefully I can do it rapidly.
Yeah, there's no time for too long of talking, so they put both of us on the wrong podcast together. So who is someone in your life that was a great leader, and what makes them great?
I'm super inspired by my team. There's a lot of amazing leaders within Coviance that I actually learn from every day. Our chief operating officer, our CRO, and then even the VP level folks here are such great leadership. And I think what we focus on, creating an environment for our team to feel free to create versus do it because Omar said so or Mike, the CEO, said so. There's a lot of collaboration that takes place. And I learned from within the team itself, where they're able to share and communicate with us what creates a great working environment for them. And we've seen a lot of success by inviting our customers to the conversation too, in terms of how we develop. So we have an advisory committee that talks with our customers every day and brings in new good ideas. So leadership starts from within the organization for me. But I'm inspired by a lot of leaders in this industry, and all the way from the NCUA all the way down to a teller at a credit union. There's a lot of great leaders in this industry.
I love that. And having known Coviance for quite some time, I know that you've always surrounded yourself and injected your organization with some really great leaders. So it's no surprise to hear you say that. So when you're traveling for work, what city are you most excited to visit, whether it's a client visit or for a conference that we often end up near each other at?
Yeah. I love DC for some reason. I don't know why. It's such a great town, great restaurants. People are great. I love the architecture there and just the hotels there and the staff and the service. That's one of my favorite spots to be. And nothing beats GAC, where you get to see the entire industry sort of go to this one spot and you're seeing all your friends and your family. And it's a lot of hugs and just the kind of celebrating the year together. I think GAC is one of my favorite conferences. And I'll say DC is probably one of my favorite towns. A lot of great steakhouses there.
I like it. Yeah. Certainly a foodie, huh?
Yeah, for sure. Well, yeah.
So a hard-hitting question.
Yes.
What did your Spotify wrap up for the year look like?
It was quite pathetic. I was kind of disappointed in number one was K-pop Demon Hunters. I have nothing but girls at home. They loved K-pop Demon Hunter. And then number two was Casey Musgraves and Lainey Wilson. I didn't know I listened to that much Casey Musgraves and Lainey Wilson outside of K-pop.
I just appreciate the fact that your car likely looks like in-car DJ like mine does. And that makes me feel a little bit better.
Oh, yeah. No, you got to do it as a father of girls. Sometimes I got to let him put the makeup on my face every now and then just to kind of have fun with it.
It's good for you. So what is your best hack for creating balance and integration between your work life and your life?
That comes with age, Robbie. For me, in my 30s and 20s, it didn't matter. I was working so hard, working from 9 a.m. to midnight every day. It didn't matter what my kids had at school. I wasn't there. I was building this company. That was my focus. And I think at some point, it's just hit me that, and there's nothing wrong with that, by the way. If you're a young entrepreneur and you don't have the responsibilities as a father to do a lot of things that us parents have to do, go work, go show us your battle cries, go earn it. And then it gets to a point where your kids grow up and you just kind of learn that there's not much time with them until they go to college and off they go. And so I try to put my phone down and focus on family time when I'm home. Sometimes I think what I learned is transparency is key, even with my kids. And so if I must take a call or have to go on a conference, I communicate that to them to set the expectation that I'm going to be busy. But outside of that, I learned that at an old age, when you hit the 40s, you just start to reflect. You say, let's spend a little bit more time with the kids. There's not much time left. Outside of that, if you're young, go work. There's no excuse. I expect you to be there from 9 a.m. to midnight.
I like that. And the balance comes when the kids demand it.
Yes, for sure.
So we'll be sure to link to everything we talked about in the show notes. My last question for you is, do you have any final thoughts you'd like to share or asks of our listeners?
Look, if I am super inspired about what's happening in this industry, I'd say in the last couple of years, it's been so much to see this change and change makers like you and a lot of what's going on with the Circle Fund and other funds within our industry. And so Venture Tech was a great conference. I encourage everyone to go there and just kind of learn and inspire. Look forward to see everybody in DC, of course, at GAC, but there's a lot of fun to be had here in the coming years. This evolution of technology that's moving radically fast. It's going to be fun to see it unfold. And I'm so glad that credit unions are embracing it. And I hope to see more of that.
Well, thank you again, Omar, for being on the show. Stay well, and thanks to all of our listeners for tuning in to the CUInsight Network. We will be back again next time.